Wednesday, December 15th, 2021, Monaco 64, home of alternative economics and contrarian views. Today, we're joined by Nick Barisheff. He's the founder, president, and CEO of Bullion Management Group, or BMG in Canada. Nick, welcome to the channel. And before we go on to the interview, could you go over your background and the background of your company a little bit?
Well, I started the company in 1998, and primarily because in Canada there wasn't a suitable investment vehicle to allow physical precious metals in registered retirement accounts. And there was various ways of doing it, but I chose that the best way would be an open-end mutual fund trust, because that way the liquidity would be the same. You would be trading in and out of the precious metals markets, and there would be no premium or discount to net asset value of the bullion. So it was the closest thing to structure that acted like real bullion, but still qualified for RSPs, which at the time in Canada, you couldn't hold bullion in RSPs. But then it took me 4 years to get the approvals in Ontario. In Canada, the securities regulators are provincial. There is no national securities regulators. So I spent 4 years with Ontario. And after getting that done, it was another year to get all the other provinces and territories done to where we were, national. So that was kind of how we started. And like I said, we've been in business ever since. We've got now 3 mutual funds. The first one was a gold, silver, platinum fund, where the fund purchases equal amounts of the metals. Then we created a gold only fund, and the last fund was a silver only fund. And then about, I guess, close to 10 years ago, we spent about 5 years writing the software to allow high net worth investors and family offices and institutions to buy physical bullion in their name and have it stored around the world. We have relationships with Brinks in Hong Kong, Singapore, Dubai, Geneva, Panama, and of course, Canada. So that's kind of the overall of the company. And it's been quite a journey, because going into it, I grossly underestimated the difficulty of getting gold into investment portfolios.
Yeah, I guess from the regulatory standpoint, and also maybe convincing investors and pension funds to do so.
Yeah, you see, everybody talks about diversified portfolio, but really they only have stocks and bonds in most portfolios. Virtually all of portfolios are missing precious metals and REITs in terms of those two asset classes. And when you look at the performance over 20 years, the REITs are the best performing asset class. Gold is second, then stocks, then bonds, then cash. And to have a truly diversified portfolio, you need a meaningful percentage of all of them.
Yeah, and so you wrote a book called Why $10,000 Gold. Could you go over that book a little bit and why you picked that price, especially in this period of time right now where sentiment for gold And also the mining stocks are very low. I see that today. The miners are getting hit even harder. And we've got the Federal Reserve FOMC announcement in about 2.5 hours from now. And I've been buying gold since 2002. I have listened to you before. I remember, I think you used to go on Financial Sense News Hour with Jim
Right.
Fava. So I remember you from then. And yes, and I've been on this journey since then. It seems like frustrating because precious metals investors, they expect gold to move perfectly with news and fundamentals, but it seems to go in spurts. So maybe if you could go over that title and your book.
We look at it as a long-term portfolio investment, and I also, purchased gold and silver, before I started the company. And people say, well, they're disappointed in the performance and so on, but the average annual increase in gold in all currencies has been about 11%. Okay, now, whether you take the most sophisticated pension fund portfolios and so on, they're not getting 11%. They target for something like 6, and many of them miss the mark. So I look at it and say, well, getting 11% while you're waiting because the gold price is grossly undervalued, and the conditions that will ultimately cause it to go to 10,000 or beyond are even more so than I wrote the book.
Is the 11%, is that since you wrote the book?
No, since 2000.
Since 2000, okay.
Since I started the company. So I, because I hear that I'm disappointed in the performance. Well, as a portfolio diversifier, which should be 10 to 20% of your portfolio, it does exactly what it was supposed to do. And at some point in time, when the price does go ballistic, then you have a big bonus. Now, when I wrote the book, the main premise of 10,000 was the fact that the price of gold was almost perfectly correlated to US debt. And then and coincidentally, once the book came out, that relationship diverged. US debt accelerated while the gold price declined. Now, the only justification for that is that it has been manipulated on many fronts with paper gold, and that's what's kept in line. There's no other explanation. You get a taste of that divergence if you look at, like in here we have eBay and Amazon, and when you look at the price of coins that are selling, and it's relatively a liquid market there, they're dramatically higher than the paper price of gold. So already there's a big divergence. But ultimately, people get misled. We have a Fed announcement, and people think that if the Fed hikes interest rates, that'll be negative for gold. The reality is that nominal interest rates don't affect gold. It's the inflation adjusted rate. So for example, in the 70s, interest rates were rising. They got to 18%, but they were still negative until they hit 18%. And right now, we've got official inflation at 6-7%. But the true inflation, if you looked at kind of 1980s methodology, which Shadow Schatz does, the true inflation rate is 15%. So you've got a huge negative yield in terms of rates. And even if they increase rates, the historical mean for interest rates has been 5%. There's no chance they can increase rates to 5% without causing a bloodbath in the economy.
Yeah, I just saw an article, editorial from Kevin Warsh, who was a former Fed governor, a couple of days ago in the Wall Street Journal, and he said the same thing. The Fed is held on for too long. They've accommodated for too long. And now if they try to reverse everything, it's going to be a disaster. And I was looking at the Fed's QE and tapering and rate rise in the last cycle. I mean, it took them 10 years to start tapering their balance sheet from 2008 to 2018. And it took them like 8 years to start raising rates from 2008 to like late 2015, early 2016. So right now, I just think the mainstream media, mainstream economists, they kind of ignore the fact that the balance sheet has exploded higher. M2, M1 has gone through the roof. Debt is much higher. And the Fed is really trapped if they try to do something very quickly.
In 1980, when Volcker raised interest rates to 18%, that total amount of debt was only a few hundred billion. Now we're approaching like 29 trillion. So
yeah, and yesterday I think Congress just approved another increase in the debt ceiling of 2.5 trillion. I mean, it's just crazy. So
these numbers used to be billions, now they're trillions.
yeah, it's a bit like in the old days in Italy when they had the lira, 5,000 lira for a sandwich. So moving on, what's your feeling about the mainstream and even Wall Street now trying to push cryptos? Do you think cryptos have taken a little bit of attention away from gold and silver? And I actually think that's personally, I think that's a good thing, because for an asset to be reasonably good value, people need to hate it. I think it was a little bit like in the late 90s, early 2000s. No one wanted to have gold and silver, but that was the best time to buy it. How do you see that same kind of environment right now?
Well, when the whole idea of digital currencies came up, I did some research, and you know, although now they're called cryptocurrencies and blockchains, but there was many different attempts at some form of digital currency or alternative currency. In virtually all the cases, the currency started to be used by drug money, pornographers, etc. And the entities were raided by the Fed, and not by the Fed, by the authorities, and people got arrested. Now, in some cases, maybe they got set up, you know, with illegal activities. But the main thing is that if the current level of cryptos become really popular, as far as I'm concerned, there isn't a snowball's chance in hell that the government is going to allow them. Okay, so right now they've been an annoyance, but if they become serious, they'll shut them down either through taxation or outright banning. China has already done that. A number of the governments are creating their own blockchain, intending to introduce their own cryptocurrencies. And when they do that, the private cryptos will be shut out. And the current rise in terms of the values, that to me, that's just like tulip mania. There's nothing justifying the value other than the momentum and the investor's attitude for it. So it's been a good little rise, but it'll end in tears in my view.
And the other thing I've noticed is a lot of the people who are, they call them sometimes Bitcoin maximalists or crypto enthusiasts. They say that central banks will eventually have to buy crypto. But aside from El Salvador this year, what I've seen is that central banks have accelerated their gold buying in 2021. What do you think that's about? Is that to do, you think, with Russia and China trying to build an alternative financial system? Because today we had a story that just came out from Russia and China that they've agreed to basically build their own parallel or alternative financial infrastructure, and I think that was a significant statement.
See, the piece that's missing in my view of this is that China has made no bones about the fact that they intend to have more gold than the US. And both Russia and China have publicly stated that they don't like the control the US has because of the reserve currency and want alternatives. Now, the thing to understand is Chinese central bank purportedly has 1,500 tons, but they buy the gold through their sovereign wealth fund. Now, the sovereign wealth fund doesn't report anything to anybody, but all the various analysts think that China already has north of 5,000 to 6,000 tons in the sovereign wealth fund. Now, as long as the price is down, they're accumulating because they want to get in total more than 8,000 tons. So they're not going to announce that, but when the time is right, they'll transfer the gold from the sovereign wealth fund to the central bank and say, here we are, we have X number of tons. The problem with that is that the two main reporting services are GFMS and CPM, and they've accounted for every fraction of an ounce in terms of supply and demand. So if China announces that they have 5,000 tons, where did it come from? Because it's already been accounted for. The only thing that hasn't been accounted for is leased gold. And gold that the authorized participants borrow from the central banks, contribute to the ETFs. When the ETFs want to redeem, they act as market makers, but then instead of repaying the gold, they sell it to China. So the problem with that is going to be if China ever announces that they have X number of tons, means that the Western central banks in the US doesn't. And this has been the anomaly. When a central bank leases its gold, it doesn't have on its financial statement so many ounces of gold and so many ounces as promissory note. It's still as if all the gold is there in the central bank, which is an absolute farce. It's not there, and it's not coming back.
Some people also argue that a lot of the gold mining that goes on in China, that China has been not exporting any of that gold and adding to its reserves like that. Do you think GFMS and CPM have accounted for that?
Well, because they can't really, because that's not officially publicized anyway. And Russia too has been buying all its mined gold as well. So China now is the #1 producer. I think Russia is number 3 or 4. So that's a significant amount of gold that doesn't come onto the market.
So they could actually have a lot more than we think, even
That's
more
right.
than the 5,000 to 6,000. Yeah.
That's right.
So, yeah. Do you think gold could revert back to being like an anchor for currencies around the world? And by that, I don't mean really having a system, but just like countries trading with each other with their own currencies, but using gold as a settlement instrument, like it used to be before the 19th century, before the outbreak of World War I. Do you think that's possible, or is that just
One of the things is the special drawing rights, which is a basket of currencies. And that basket varies according to a complex formula, but that complicated formula includes gold holdings. So when countries settle trade deficits, they use SDRs often. So that could have an impact where a country's gold holdings will increase their allocation in the SDRs. So it's kind of an indirect gold standard.
I see. I see. Any thoughts on Basel III and how it could impact the gold price this year? There's been a lot of speculation about Basel III, and I think from January 1st or 2nd, the London bullion banks are going to be liable to those rules, even though I don't think those rules are forced in them. They're just like, how can I say, guidelines. What's your
Right.
view on Basel III then?
Well, if they come in place, it should curtail a lot of the paper gold manipulation. So that would be a good thing. So it remains to be seen if it'll actually do that or not, because the rules would make it quite unattractive for bullion banks to play games with leveraged gold, leveraged paper gold.
I've tried to tell my viewers as well about Basel III not to get too excited about Basel III and to look at gold more and silver more as a fundamental important monetary asset to have as insurance, or as you say as well, it can serve as a portfolio, balance your portfolio if you are a big investor. Moving on, a little more towards the markets here. What's your view of gold versus silver? I've just looked at the gold silver ratio recently, and we are at pretty elevated levels, maybe not as elevated as last year when we got to like 125, but we're back above 80, which historically has been a pretty important level.
Well, there's quite a large difference between gold and silver, because gold is primarily a monetary asset, and there's quite a lot of pure gold mines all over the world. Silver, on the other hand, is partially monetary, but mostly industrial commodity. And there's very few pure silver mines. So a lot of the silver production is byproduct production from other metals. So the importance of that is that if the price of silver was to rise, normally you'd see increased mine production, but that's not going to happen necessarily. So what I say is that silver is price inelastic from a supply and demand point of view. So supply, because very few primary silver, but from a demand point of view, when you look at the uses, the industrial uses in electronics, cell phones, solar panels, electric cars, whatever, there's actually a very small amount of silver used in the end product, but without it, you don't make the end product. So let's say a cell phone is $900, but you've got 25 cents worth of silver in it. but without the silver, you don't make cell phones. Now, we've had a taste with the chip shortages and what that has done to this disrupt production and so on in a lot of industries. But sooner or later, some of the tech giants, the billionaires, the companies are going to figure out, I'm out of business if I don't have silver. And they're going to go into the market and buy billions of dollars in a swath. Now, people, may say, well, yeah, that's never happened. Well, it has happened. In 1998, Ford needed to, they were using palladium for their gasoline catalytic converters, and they bought $5 billion of palladium in one swath, because without it, they're not making cars. So sooner or later, the people running the tech companies are going to realize that's a huge vulnerability, and there is no replacement for silver in the electronics. I mean, you can get similar characteristics with gold, but at almost 100 times the price. So that's going to be a big impact on the silver markets eventually, and something can happen overnight.
Yes, and any view where that ratio could go? Because usually in a precious metals bull market, we tend to see silver outperform.
Mm-hmm. Well, I think that because as the gold price rises, silver has to normalize back to the historic mean, which is about 40. So it means it needs to double just to equalize up. And if gold starts rising, it's got a catch up to do and rise, so you get a sort of a double whammy there.
All right. And what about the miners, gold and silver miners? I see today there's like kind of a capitulation. I was watching the market earlier. Any view on bullion versus the miners?
Well, for the miners to perform well, you need two simultaneous things. You need the gold price of the metals rising, and you need a bull market in equities. So what happens is, if you have a big decline in equities, the gold price goes up. But the miners have tended to have a bigger decline than the broad equity markets. And the reason for that is if you can take the market capitalization of all the mining companies in the world, and that's less than Microsoft. So if there's any kind of a sell-off, they get sold out dramatically. So my view, both personally and what I tell people, is that the miners will make a great investment when the equity markets have their crash, because then you'll buy miners at 20 cents on the dollar.
I
So
see.
in the meantime, you sit it out in gold.
I see. So you think it's still too early to get on to the miners. You still see a crash in the general stock market soon, or?
Well, the stock market's grossly overvalued by every traditional measure. In most cases, we're at 1929 levels of overvaluation. And the reason the stock market has done well is because of the Federal Reserve in terms of how much money they put into the system. It's got to go somewhere. So it's got into the stock market, it's gone into a lot of real estate. And now we're seeing it going into consumer and products, and we're getting consumer inflation. But we've had inflation in asset classes.
All right. So to wrap it up, Nick, could we look into China a little bit and the situation in the real estate market there as it concerns Evergrande and its repercussions for gold. I've seen that some other smaller companies have defaulted as well recently.
Well, I think is think about Evergrande as Lehman times 10. That's what Evergrande is. So as they default in that, they've got, I think, 800 billion in loans from 300 banks all over the world. So there's going to be cascading defaults as they default to those banks, and goes on and on. Like I say, Lehman times 10.
So you think, do you think that the Chinese government or central bank could use their gold reserves to reliquify the system then if it
I doubt they're going to do that. I think they're going to let the foreign banks take their hit. Why should they bail out the foreign banks?
what about the financial system in China? Don't you think that could be hit as well?
It's precarious as well, because there's so much wasted money in terms of the ghost cities and real estate they built that, it's like empty. So sooner or later that has, that chicken sort of has to come home to roost. So it's to me a disaster waiting to happen.
And I guess you see having some gold in your portfolio is good insurance, just because of events like this, possible events.
Well, I go beyond having a little, like, personally, because sort of I'm from the old school, and in the old school, when markets got too volatile, you would take your money off the table and sit it out. And people have been sold on the thing of always staying invested. Right now, I think a more meaningful strategy is you sit it out, because the vulnerabilities are so high. And what people forget is if the stock market tanks by 50%, you need 100% just to break even. And the length of time for the baby boomers, they won't live long enough to break even. 1929 took until the mid 50s to break even without inflation adjusted, and something like 84 inflation adjusted. So they keep saying, well, I'm missing out on the gains and the gains. Well, let's say that there's another 10% in gains. So you want to risk 10% in gains against 50 to 70% losses? So just sit it out. Okay, sit it, and instead of sitting it out in cash, sit it out in gold. You'll have some gains. And then when the market crashes, you'll be able to buy all your favorite stocks or real estate or whatever at 20 cents on the dollar. And you'll have a great portfolio. So this is the time to, your site is contrarian thinking. Well, this is the ultimate contrarian thinking.
Yeah, hold on to your gold and wait for the liquidation in financial assets.
Buy in then.
All right. Thank you very much, Nick. It was great having you on, and hopefully we can talk again. I wish you all the best.
Okay, all the best. Have a great Christmas too.
You too. Oh yeah, Merry Christmas to you as well. Thank you.
Take care.